as we start to see the Biden administration forming as well. We've heard that Janet Yellen is going to be the pick as Treasury Secretary. That brings us to our quote of the question of the day, I should say. And how do markets really price Yellen here?
Oh, I think markets will be quite supportive of this move. To the point that was made in the report earlier, she is a known quantity. There's no real surprise there. I think the way that markets are looking at it is probably twofold. The first is that purely from a market's perspective, Biden could have chosen somebody who was a little bit less favored by market players, obviously somebody who's a bit more interventionist, somebody who's a little bit more anti-Wall Street. There's no suggestion in Yellen's recent history that she has any real agenda against Wall Street. I think it'll be seen as a good, safe pair of hands to the extent that she has the international experience. I think that is fine. I think there's a second issue here, though, which is probably worthy of deeper analysis, which it'll take a little bit of time to see how this will filter through. Yellen, she's a labor economist by training, and so now that you have a Biden administration, a Democratic administration, and you have someone who at the Treasury clearly has a vested interest in labor economics, then that will start to get people interested in the potential fiscal impact and simply what policies the Treasury will be able to push through and the implications that will have. I guess eventually we'll be talking about inflation again someday. We won't be as yet. But markets will be looking at this and thinking, you know, this is another little notch probably towards higher yields at the long end. So it'll be interesting to see how that plays out for risk and for the dollar going forward as well.
Yeah, and also in terms of equities, because we've got this vaccine optimism too. I note that you still favour US equities. Does this momentum continue? Does the rotation trade continue too? And how much further upside? We're getting some pretty big calls for what the S&P 500 will look like in a year's time.
Yeah, well, to the point that if you have Yellen at the Treasury and if you start to have a little bit of pressure at the long end, and I don't want to overestimate that because we don't have inflation as such, but if the policy is one of an expansionary fiscal policy going forward, I think it's natural to assume that at some stage you're going to see a little bit of pressure on yields. In absolute terms, that might be very little. But in a terms of percentage change, it might be quite a lot. So that will certainly have a bit of pressure, or put a bit of pressure on the bond markets potentially. At the same time, though, if you're then looking at rotation from bonds and into equities, or if you're looking at that split between asset markets, equities here still look to be very well favoured, given the story on the vaccine, given the fiscal expansion, given the continued very weak or very accommodative, I should say, monetary policy situation. That all seems to back up the equity markets more than it does the bond markets. So that rotation into equities is something that we're expecting still, particularly from a U.S. perspective, into 21. We think that will be one of the key asset class stories of 2021, is that shift still into equities. So, in other words, more upside on equities as far as we're concerned.
Wow. Okay. And what about in terms of the commodity market? Because we've got oil at this 8-month high. There's a lot of vaccine optimism, but at the same time, every time it looks like we're getting closer to some kind of return to travel, that does seem to stop. So do you see normalization to the oil market in the next, say, 6 months or so?
It actually depends on a number of factors, and the vaccine and the normalization of travel will be one factor. I wouldn't underestimate, though, how important it will be once we get into a new U.S. administration that policies on the Middle East, and particularly policies on Iran, will become a far more important sort of swing factor as far as the oil markets are concerned. So I think there are a number of potential issues for 2021 around the commodity market that is not yet clear. And U.S. policy in the Middle East probably has more of an impact than we're currently sort of pricing in. If we see normalization, however defined, but if we see normalization between U.S. and Iran, and we go back to the relationship that we were maybe 4 or 5 years ago, pre the Trump administration, then a lot of the risk premium out of commodity markets could be taken away, in which case there is some potential upside there for commodities. But I think we've got a number of hurdles to get over first. So the demand component is one, obviously, but also the political element here is going to be very important at the beginning of next year. Potentially that looks more optimistic, given political relationships between a Biden administration and Iran, and of course its relationship with Europe going forward as well. So a number of factors to think about there in terms of commodities.
Dwyfor, quick word on, just very quick answer, on inflation here. We've seen 10-year yields just creeping up. Are we, at the moment, discounting the return of inflation far too much? And where would it come from?
Oh, it depends who you're talking to, and I'll tell you why, because I've had this conversation a few times in the last couple of weeks, and there are some that are arguing that we really are underestimating inflation, and hence a very strong call that some are making in terms of fixed income going forward, and in terms of fixed income being incredibly sort of overextended here, given the level of yields. We don't see that. We actually have internal metrics at State Street where we look at alternative inflation sources. We're not yet seeing inflation. The one thing, of course, that we've got to be aware of is as we go through 2021, the first 6 months of next year, we're going to get a lot of odd data when it comes to inflation because of how the base effect works in terms of the 12-month calculation. So we are going to see spikes in inflation because of how weak inflation was during sort of Q2 this year. So there is going to be a bigger debate, I think, on inflation next year. We're not yet seeing an inflation spike. We're not yet factoring in the return of inflation. But I think as we go through next year, particularly if we get more policy shifts, particularly if we get more expansionary fiscal policy, my suspicion is we will talk a little bit more about inflation. And then the question that I came back to earlier on regarding the split between equities and bonds will become a far greater factor. So not an issue for now, but I think it will be discussed in a lot more debate and a lot more scrutiny towards inflation as we go through next year. But not for now.